we'll know that we're in a precious metals bull market. Some point in time, I don't know if it's 6 months later, 12 months later, you'll see silver lead. I don't know why that is, Daryl. I love to be able to explain things. I don't know why it is. I just know from being a salient creature on Earth investing for 50 years that it's true. You own gold in large measure because of fear. You own silver, unless you own it for transactional purposes, for greed. It happens later in the cycle, and it's for your speculative money. It's not for your real money.
RickRule, a seasoned investor with over 40 years in the natural resource sector, specializes in precious metals and energy investments, and remains a crucial figure in the commodities market. RickRule anticipates that a precious metals bull market will eventually emerge, with silver likely taking the lead later in the cycle. Based on his 50 years of experience, he highlights that silver is more suitable for speculative investments rather than serious capital. This perspective aligns with historical trends, where silver often outperforms gold when U.S. growth and inflation are rising, while gold generally leads during periods of decline. As inflation begins to rise, silver's price is expected to follow past patterns, suggesting that it could be a strong candidate for speculative investments in the upcoming cycle. Additionally, the gold-to-silver ratio typically decreases during bull markets, making gold less valuable than silver. Gold's historical performance is driven by investors seeking to preserve their purchasing power, which increases demand amid growing economic concerns. Global political challenges, such as the U.S. using the dollar and the international financial system to exert its influence, further support this demand. Historically, gold is viewed as a hedge against inflation and currency devaluation. When gold's price rises faster than inflation or currency depreciation, it indicates a decline in purchasing power relative to gold, reinforcing its role as a safe haven asset. Gold typically appreciates during heightened geopolitical tensions and policy uncertainty, highlighting its importance in preserving wealth during uncertain times. Before we dive into the video, please subscribe to our channel, hit the bell icon for notifications, and share it with anyone who might benefit from it. Your support helps us bring you more valuable content.
Gold has done well over a millennium because investors and savers have been concerned about the maintenance of their purchasing power. And as they become more concerned, they own more gold. Gold is also doing well because of political challenges. Around the world, other governments have seen that the United States government is using the US dollar and the world financial system to impose America's political will on other places. As an American, you may believe that's a good thing or a bad thing, but people in China and India and Russia and Iran and Brazil and South Africa and Saudi Arabia don't want the U.S. government to tell them what to do. When the U.S. government stole $100 billion worth of Russian holdings of U.S. treasuries, whether or not you believe it was the right thing, it sent a message to people around the world. You can't save in U.S. treasuries because if the U.S. government doesn't agree with you, they'll steal your money. As much as they don't trust us, they don't trust each other even more. So you won't find the Chinese buying Russian treasuries, right? You won't find the Russians buying South African treasuries. You won't find the Brazilians buying Iranian treasuries. The only universal medium of exchange that's simultaneously a store of value outside the U.S. system is gold. And so foreign central banks have been buying gold not because they necessarily believe in gold, but because they believe in it more than they believe in other stores of value that are mediums of exchange. I want to talk about Americans not trusting the maintenance of purchasing power in U.S. dollars. And I hate always to go to math, Daryl, but I have to. That's how I think. I don't think in stories. I think in numbers. The U.S. 10-year Treasury is paying about 4 right now, right? And of course, the government will tell you that the CPI tracks purchasing power, which is a lie. You know, if you go to the pump or you go to the grocery cart or you go to your insurance charges or you go to your rent, the idea that inflation is 2.6 a year, that your decline in your purchasing power is 2.6 a year is so stupid I can't believe they can tell it with a straight face. But anyway, I assume, and we've talked about this before, that the basket of goods and services that you and I buy means that our savings are deteriorating about 7.5% a year. So if we're saving money and getting 4, but the 4 that we're getting is buying us 7.5% less, we're actually losing 3.5% a year. Now, there shouldn't be anything in the world that make you more concerned about the maintenance of your purchasing power than an ironclad government guarantee that you are going to lose money. And because of that, because of the disparity in arithmetic between the real rate of inflation and the nominal rate of payment on savings, of course people are afraid of maintaining purchasing power in their savings. And because of that, of course, people are beginning to stray into gold.
RickRule is uncertain about the exact timing of a precious metals bull market, but suspects it will begin once the gold narrative gains broad acceptance. At that point, investors may shift towards leveraged investments, such as specific gold-focused ETFs, rather than physical gold. A breakout in these ETFs relative to gold could signal the start of a bull market. Historically, gold miners experience significant gains during gold bull markets, suggesting they may outperform again. For instance, the GDXJ has delivered a 35% return, slightly surpassing gold's performance over the same period. Several leading gold mining companies show growth in operational cash flow, indicating they could become highly profitable at current gold prices. As gold prices rise steadily and rapidly, these miners could be undervalued, offering potentially more excellent profit opportunities. Additionally, RickRule notes that silver typically lags gold in precious metals markets. A strong gold narrative often precedes silver's rise. He observes that gold is usually purchased out of fear, while silver is bought later in the cycle for speculative reasons rather than as a core investment. Let's get back to the video.
My experience has been that silver reacts later than gold, that the gold narrative has to be established before silver takes over leadership. How do you know when we're in a real precious metals bull market? Let me say to begin with, answering my own question, I don't know, but I have a suspicion. I think when the narrative around gold becomes generally accepted enough that people are looking at a leveraged way to play the game. Rather than buying physical gold, they're buying the GDX or the GDXJ. And I think probably if we see the GDXJ as an index break out against gold, we'll know that we're in a precious metals bull market. Some point in time, I don't know if it's 6 months later, 12 months later, you'll see silver lead. I don't know why that is, Daryl. I love to be able to explain things. I don't know why it is. I just know from being a salient creature on Earth investing for 50 years that it's true. You own gold in large measure because of fear. You own silver, unless you own it for transactional purposes, for greed. It happens later in the cycle, and it's for your speculative money. It's not for your real money. In the late part of the 1980s, the suspicion in financial markets was that silver was a pet rock. It wasn't ever going to go anywhere, ever again. It was selling for $4.50 an ounce or something like that. And a group of us were able to buy silver deposits in the ground that had $100 million spent on them, whatever. We were able to buy them for $2.5 million, knowing that those deposits were worth nothing at $4 silver, but they'd be worth something at $15 silver. And we did this through two little penny stock companies, Pan American Silver and Silver Standard. Pan American Silver, we underwrote, I'm going to say 1990, at 50 cents a share, and Silver Standard a little while later at 72 cents a share. And in 6 years, both those stocks are trading above $40. Less than $1 to $40, total elapsed time 6 years. Now, both of those companies could have gone broke. Both of those companies, in the 6 years I held them, exposed me to 50% share price declines a couple times. You know, they go from 75 cents up to $2.50, back to $1.50, up to $5, down to $3. You know, it was like a rodeo ride. So you had to be persistent and you had to be tenacious. But the reason that you take the risks on the silver juniors is not because you think they might go up 30% or 35%. It's because you think that there is a possibility where you can afford to take the risk that they'll go up 1,000%. That's why you do it. And if you can't afford the time and you can't afford the risk of loss, man, don't even think about it.
If gold prices experience significant growth, investors might begin favoring more leveraged investments, signaling the potential onset of a precious metals bull market. As gold's importance becomes more widely recognized, these leveraged options could attract increasing interest, marking a shift in market trends. Silver, which typically follows gold's lead in the precious metals market, could gain more attention and possibly outperform, mainly as the narrative around gold solidifies. What are your thoughts on the current potential for gold and silver? We'd love to hear your insights. Share them in the comments below. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and hit the bell icon for updates on our latest content. Thanks for watching.